our series. My name is Leonard Bach from Dezan Shira Associates. Before we begin, allow me to introduce our firm. Dezan Shira Associates is a specialist foreign direct investment practice with pan-Asian presence, providing services ranging from tax and business advisory, accounting, payroll, due diligence, and financial review services to multinational companies investing across emerging Asia. The firm has been established in 1992 and since then has grown to more than 20 offices in 5 jurisdictions where the company provides a spread of local, Asian, and global expertise. Dezan Shira has a large presence around Asia with offices in 11 Chinese cities, Vietnam, and Hong Kong and Singapore. In India, Dezan Shira Associates has offices in New Delhi and Mumbai. We also have special liaison offices in Italy and the United States. Today with me is Gunjan Sinha, Country Manager of Dezan Shira Associates offices in India. She is here to present India's key taxes and duties affecting foreign established businesses in India. Ms. Sinha has expertise in FDI regulations, legal advisory, corporate establishment, and tax advisory. Today we'll start by looking into the important taxes for foreign investment firms, followed by the avoidance of double taxation. Afterwards, we will also have a look at the most important duties. Gunjan, can you begin by describing the general tax situation in India?
Taxation in India may at first glance seem difficult to understand. This is mainly due to its reputation of controversies about retrospective amendments. Especially the Vodafone case caused worry among foreign investors. Despite that, the following slide's aim is to provide an overview of the relevant taxes for foreign invested entities along with the taxation agreements (DTAAs). I would like to begin by mentioning that the tax situation in India has to be assessed from a federal and state level. Central and state governments provide various tax incentives for foreign investors establishing companies in India, including indirect and direct tax incentives, reductions in indirect taxes, special tax provisions for 100% export-oriented operations. Furthermore, special economic zones offer additional important benefits.
What are India's major taxes that a foreign invested entity is required to pay?
The first and most important tax for foreign invested entities is the corporate income tax, which is levied against profits and income under the provisions of the Income Tax Act. Corporate income tax must be paid by all types of foreign invested entity except for liaison office. Foreign and domestic companies are subject to different corporate income tax rates. Apart from the income tax, there are 4 major other taxes: value-added tax, service tax, capital gains tax, and withholding tax. The value-added tax is a type of tax that the Indian states impose on most type of goods at a standard rate of 12.5%, is the VAT, with some cases the same tax being a lower rate at 4% and 1%. There is no VAT on imports into India and exports are zero rated. Exemption rates are subject to individual regulations by the states. The most prominent figure here is INR 5 lakhs, around $8,400. Those companies providing taxable services are liable to pay service tax, which is levied at 12.36%. Small service providers are exempted from service tax where value of taxable service does not exceed rupees 10 lakhs in the previous financial year. The tax rate on capital gains in India varies based on the type of asset. Different rates apply for shares, property, debt instrument, the length of time the asset was held, and whether transactions have taken place on a recognized stock exchange. The tax rate applicable to business income of non-residents is higher than the rate applicable to domestic entities and stands at approximately 42%. Equities held for more than a year are considered long-term asset and are exempt. Short-term capital gains are taxed at the normal corporate income tax rate, of which is usually 30%. The said taxes can be reduced according to the Income Tax Act by deduction of tax at source on payments. These provisions are also applicable in case of payment made to non-residents.
What are double taxation avoidance agreements, DTAAs, and with what countries does India currently have such agreements?
Double taxation avoidance agreements (DTAAs) aim to prevent the same income being taxed by two or more countries, while also eliminating tax evasion and encouraging cross-border trade efficiency. DTAs usually work by allowing the tax paid in one of the two countries to be offset against tax payable in the other country, or by providing exemptions or reduced tax rates for specific income types, such as interest, royalties, and dividends. In India, the withholding tax on dividends is 0% per Income Tax Act, but DTs as serve to reduce double taxation on interest and royalty rates. The table shown reflects some India's most important double taxation avoidance agreements in effect. In certain cases, such as the states of the former Soviet Union, the rates represent treaties between group of countries. In treaty that do not specify a maximum withholding tax rate or have a maximum rate specified that is higher than the domestic withholding tax rate, the domestic rate applies. For countries with which India does not have a DTAA, the Income Tax Act provides certain reliefs to avoid double taxation.
What are the major duties a foreign invested enterprise is expected to pay?
Customs duty is an indirect tax imposed on goods imported or exported from India. The situation surrounding the export or import of goods determines the imposition of tax. Regulations related to customs duty are governed by the Customs Act, which collects duty for imports and exports, implement procedures, prohibits trade of certain goods, and impose penalty for offences. There are several types of custom duty taxes that I would like to mention in here briefly. There is the BCD, Basic Customs Duty, Additional Customs Duty, Anti-Dumping Duty or Safeguard Duty, and the Education Cess. The Basic Customs Duty is a standard rate set out for a specific commodity. Preferential rates may apply in the case of imports from specified countries. The additional customs duty is imposed to counter the impact of the excise duty. It is equal to the central excise duty and is added to similar goods produced or manufactured in India. It is commonly referred to as countervailing duty or CVD. The conditions for imposing CVD are such that the duty is only imposed when the imported articles are produced in India. The imposition on additional duty is based on the aggregate value of goods, including landing charges and the basic customs duty. Other duties such as anti-dumping duty, safeguard duty, etc. are not taken into account. In the case that goods are covered by provisions under the Standards of Weights and Measures Act, the value base will be the retail price declared on the package of the goods minus the rebate as notified for such goods. When foreign products create the need for the domestic market to be protected because of unfair market practices, anti-dumping duties or safeguard duty are imposed. Goods that are imported by the 100% EOU export-oriented unit and units in FTZ free trade zones and SEZ special economic zone are usually exempt. Additionally, a duty specifically levied on products imported from one country can be imposed as has been the case with China. An education cess and secondary higher education cess, presently levied at 2% and 1% of the duty respectively, are imposed at the prevailing rates of custom duty.
Thank you very much for listening to this episode of the Investing in India webinars with Gunjan Sinha, the country manager of Dezan Shira Associates at the New Delhi office. If you have any additional questions about today's webinar, please feel free to contact with Gunjan at gunjan.sinha@dezshira.com. To help our listeners to better understand the topics of doing business in China, Vietnam, and emerging Asia, Dezan Shira publishes more business guides, articles, and podcasts which can help to do better business in Asia. In order to access these, go to the asiabriefing.com or visit the country-specific content at indiabriefing.com. Our bookstore offers more publications on key topics such as corporate establishment, financial risk, tax, and accounting and compliance issues. If you are interested in more multimedia works about doing business in Asia, such as webinars, interviews, or podcasts, please visit our website at dezgira.com/multimedia. You can also find us on LinkedIn and Facebook and follow us on Twitter for the latest business news in Asia.